Welcome to the deep dive. Today, we're going deep into the world of financial analysis, specifically a technique called walk-forward analysis. And you've sent over some really interesting material for this deep dive, some transcripts and notes on using WFA to really put trading strategies to the test.
Okay, let's unpack all of this and see what we can discover.
So what's fascinating about walk-forward analysis, or WFA as it's often called, is that it helps us look beyond the surface, beyond just basic backtesting. It's really like we're stress testing our trading strategy. We're not just looking for a strategy that wins in one perfect scenario. We want a strategy that can really handle the real world with all of its surprises.
So instead of just looking back and seeing how a strategy did in the past, we're using WFA to understand its potential in the future, like getting a sneak peek into how it might perform when things get unpredictable.
Exactly. Think of it this way. Imagine you're back in school. You're cramming for a test. You memorize all the answers from the textbook. But then the actual test is full of questions that you've never seen before. That's kind of like regular backtesting. Ouch. I can feel that test anxiety coming back already. So with WFA, we're making sure our strategy can handle those surprise questions on the test.
Precisely. At its core, WFA involves two key phases: optimization and backtesting. And here's where it gets interesting. We have to be really careful about the data that we use for each phase. We need to differentiate between what's called in-sample data and out-of-sample data.
Okay, I'm sensing this distinction is important. Can you break it down for me?
Sure. Think of in-sample data as the practice test. It's the data we use to fine-tune our strategy, figuring out the best settings, the best parameters to use. Out-of-sample data is the real deal, the actual test. It's the data we use to simulate how our optimized strategy would perform. In the wild, so to speak.
So with WFA, we're essentially training our strategy on that practice test and then seeing if it can pass the real test on a totally different set of data. This definitely sounds more realistic than just relying on a single backtest.
Exactly. And that's why WFA is such a valuable tool for serious traders.
Yeah.
It gives you a much more robust and realistic way to really assess the potential of your strategy. Now, based on the transcripts that you've provided, it seems like there are different types of WFA. There's something referred to as basic WFA, and then there's Monte Carlo WFA, or MCWFA for short.
Yes, those are the two approaches that kept popping up in the material. Can you explain the difference between the two, like what makes them unique?
Certainly. Basic WFA is like the easy mode of WFA, especially if you're using software like AmiBroker. It's a great starting point, because it uses a fixed step size for the out-of-sample period and how often it steps forward in time. AmiBroker even has an advanced mode that gives you more flexibility in setting those out-of-sample periods. So if you want more control over the testing process, you can move beyond that easy mode.
Okay, so easy mode for getting started, advanced mode for more fine-tuning. Got it. So where does this Monte Carlo WFA fit in? It sounds a little bit more intimidating.
Think of MCWFA as stepping up to expert mode. This is where things get really powerful but also more complex. MCWFA involves running multiple simulations, not just one, and it requires some custom coding to do. You won't find this built into AmiBroker. You actually need to be comfortable writing some code to do this.
Multiple simulations? That sounds pretty intense. What's the advantage of going through all that trouble?
Because it allows us to combine the rigor of WFA with the power of Monte Carlo simulations. It's like taking WFA to the next level. Monte Carlo simulations let us explore all sorts of what-if scenarios. We can assess risk. We can analyze how sensitive our strategy is to different factors. And we get a much broader view of how our strategy might perform.
Hold on. So we're not just running one backtest anymore. We're simulating hundreds, maybe even thousands of potential outcomes, taking into account all the uncertainties of the market.
You got it. And that's why MCWFA is more about trade modeling than just trade shuffling. We're not just randomly mixing up trades. We're aiming to realistically simulate all the complexities of real-world trading, like something called slippage, and those times when you just can't get a trade filled when you want to.
Okay, you've piqued my curiosity about slippage. Can you explain what that is?
Imagine you're trying to buy a stock at, let's say, $10 per share. You place your order, but the market's moving fast, and by the time your order actually gets filled, the price has jumped to $10.05. That extra 5 cents you paid, that's slippage. Now, in the real world, these tiny differences can add up really quickly, especially when you're making lots of trades.
So those seemingly small differences can actually have a big impact on your overall profitability. That makes sense. So MCWFA helps us account for all those real-world nuances that basic backtesting might miss.
Precisely. It's about getting as close as possible to simulating what would actually happen. if you're trading this strategy live in the markets. Now, to really make this concrete, let's look at an example from the transcripts that you sent over. It talked about a strategy that was tested from 2003 to 2010. What can we learn from this example?
Yes, that example really caught my eye too. Can you walk us through what they did and why it's so relevant to our discussion on WFA?
Certainly. This example highlights a key application of WFA, evaluating a trading strategy over time. The strategy they were looking at used two parameters that needed to be optimized, MKC, which likely refers to a moving average parameter, and something called the highest high-value period. The walk-forward process began in 2003 and moved forward in 6-month increments.
So they basically divided the time period from 2003 to 2010 into these chunks of 6 months each. Then what? Did they just run the strategy on each of those chunks?
Not quite. Here's where the walk-forward part comes in. They would optimize the strategy on the first 6 months of data, let's say from January to June 2003. Then they would test that optimized strategy on the next 6 months, from July to December 2003.
Ah, so the testing period is always data the strategy hasn't seen before, like it's encountering a brand new market environment.
Exactly. And then they would move the window forward, optimize on the data from July 2003 to December 2003, and test on the next 6 months, and so on. They kept walking the optimization and testing windows forward until they reached the end of their data set in 2010.
This is where it gets really interesting for me, the way they structured this. They're not just testing once. They're repeatedly optimizing and testing as they move through time. This feels like a much more rigorous way to evaluate a strategy.
You're spot on. It's like giving your strategy a series of mini tests, each on a different slice of market history. And here's a crucial point that was emphasized in the transcripts. The results from the in-sample data, that optimization period, shouldn't even be looked at when you're evaluating the strategy.
Yeah. Wait, really? Why would we ignore the results from the period where we optimize the strategy? That seems kind of counterintuitive.
It's tempting to look at those results, but remember, we've essentially trained the strategy to perform well on that specific set of data. It's like looking at your practice test scores and thinking you'll get the same grade on the real exam. What really matters is how well the strategy does on the out-of-sample data, the data it hasn't seen before.
That makes sense. We want to know if it can perform well when faced with the unexpected, not just when it's had a chance to memorize the answers.
Precisely. Now, even though WFA is a powerful technique, it's important to be aware of its limitations. This is especially true for basic WFA.
Oh, right. The transcripts did mention some potential pitfalls. What are the things we need to watch out for?
One of the biggest drawbacks of basic WFA is that for each out-of-sample period, you're only running a single backtest.
Okay, so we run the strategy on one 6-month chunk of unseen data. What's the issue with that? Isn't one test enough?
Here's the catch. One test might not be statistically significant. Imagine flipping a coin 5 times and getting heads every time. Does that mean the coin is rigged? Not necessarily. You need more flips to get a statistically reliable result. It's the same with backtesting.
So one lucky backtest might give us a misleadingly positive result. We might think the strategy is a winner, when in reality, it was just a fluke.
Exactly. And markets are even more complex in the coin toss. Market conditions are constantly changing. So one backtest might capture a period of really favorable conditions that wouldn't necessarily repeat in the future.
Okay, I see the problem with relying on just one backtest. Is there anything else we should be cautious about when using basic WFA?
Another risk is something called overfitting or curve fitting. During the optimization phase, this happens when we tweak and fine-tune our strategy so precisely to the in-sample data that it does exceptionally well on that specific data set, but fails to generalize to new, unseen data. It's like training a dog to do one trick perfectly, but completely neglecting all other commands.
So it's a bit like creating a strategy that's really good at cramming for a specific test, but then bombs on the real exam because it can't adapt to new information.
Exactly. And this is where MCWFA can really shine.
Right.
Remember, with MCWFA, we're not running just one backtest, but hundreds or even thousands. We're essentially throwing all sorts of different market scenarios at our strategy to see how it performs. This gives us a much richer and statistically sound understanding of its potential.
That makes a lot of sense. It's like testing our strategy under a microscope to try to find any hidden weaknesses. But MCWFA does sound pretty complicated to set up. What are the trade-offs? What are the drawbacks?
You're right, there are trade-offs, the main one being complexity. Implementing MCWFA requires custom code, which can be challenging if you're not a programmer. It also demands a lot more computational power. Think about it. Running thousands of simulations takes a lot more time and resources than a single backtest.
There's a barrier to entry here. Not everyone will have the coding skills or the computer horsepower to do a proper MCWFA.
That's true. But even if you're not ready to jump into the deep end of MCWFA,
Right.
remember that even basic WFA is a significant step up from simple backtesting. It forces you to think critically about your data and to be more realistic about your strategy's potential.
Okay, so we've done our WFA. Whether it's basic or Monte Carlo, what happens next? What are the key things we should be looking for when we're analyzing the results? How do we interpret what we're seeing?
This is where the rubber meets the road, making sense of those WFA results. And the transcripts actually highlighted a crucial detail here, especially if you're using AmiBroker. You need to be really careful about how what's called the compound annual return, or CIR, is calculated.
Oh, that CR calculation just threw me for a loop. It's like AmiBroker speaking a different language. Let's break this down so we're all on the same page. Isn't CR a standard calculation? Why do we have to be extra careful with it in a WFA setup?
You're right. KRR is a standard way to measure the average annual return of an investment over time. But here's the thing. AmiBroker's built-in CR calculation can be a bit tricky when you're doing WFA. It might give you a misleading result, because it looks at the entire backtesting period as a whole, rather than the individual out-of-sample periods.
So it's not giving us a true picture of how the strategy performed. During each of those 6-month testing periods, it's like averaging your grade on all your quizzes and tests, without looking at the individual scores. You might think you did well overall, but maybe you bombed that one crucial exam.
Exactly. So you might need to manually calculate the CRR for each out-of-sample period to get a more accurate and granular view of your strategy's performance. You want to see how it performed in each test, not just the overall grade.
Okay, so we need to double-check that the reported CRR aligns with our specific WFA setup. Got it. What about other metrics? Are there any tools or techniques that can help us analyze the results more effectively?
The transcripts mention using something called cumulative distribution function, or CDF tables.
CDF tables. Remind me what those are for and how they can be helpful in this context. I'm picturing some complicated statistical charts and graphs.
Don't worry, it's not as intimidating as it sounds. CDF tables are actually really useful for visualizing the range of potential outcomes. Remember, with MCWFA, we're not just getting one result, but a whole distribution of results. From all those simulations we ran, CDF tables can help us see the big picture, not just a single point estimate.
So instead of saying this strategy will make you 10% per year, we can use these tables to say there's a 60% chance the strategy will make between 5% and 15% per year, but there's also a 10% chance it could lose money. That's incredibly valuable information.
You got it. And this is where the power of MCWFA shines through. A well-executed MCWFA should give you enough data points. The transcript suggested aiming for at least 300 simulation runs to do some really interesting analysis, like something called sensitivity analysis.
Sensitivity analysis. Now that sounds a bit more technical. Can you explain what that is and why it's so useful? Is it about figuring out which parts of our strategy are the most sensitive to market changes?
You're on the right track. Sensitivity analysis is like peeling back the layers of an onion. You get to see which parameters have the biggest impact on your strategy's performance and which ones are less critical. Think of it this way. Imagine tweaking your moving average period by a single day and seeing how dramatically your profit distribution shifts in your MCWFA results. That's the power of sensitivity analysis.
Wow, that's amazing. So we can use sensitivity analysis to find those levers that have the most influence on our results. This could be incredibly helpful in refining and improving our strategy.
Right. Maybe we could even make it more robust to those unpredictable market swings we talked about earlier.
Exactly. Sensitivity analysis can reveal these hidden relationships. It might show that your strategy is far more sensitive to volatility than you initially thought, or that a seemingly minor parameter change can have a huge impact on your profitability. Okay. I'm starting to see why MCWFA, despite all its complexity, is considered a more sophisticated approach to strategy evaluation. It gives you a much deeper understanding of how your strategy works, what its strengths are, and where its weaknesses lie. It feels like you're moving from guesswork to a more scientific approach to trading.
That's a great way to put it. It's about moving from, I think this might work, to, I have data to support this. It's about making more informed decisions based on evidence and analysis, rather than just gut feeling.
So we've covered a lot of ground today. We started with basic backtesting, then we explored walk-forward analysis, and we even ventured into the world of Monte Carlo WFA. Feels like we've gone from riding a bicycle to piloting a spaceship in terms of analytical sophistication.
It's been quite a journey, and I think the key takeaway here is that WFA, in any form. It's about moving beyond assumptions and hunches. It's about gaining a deeper, more realistic understanding of your strategy's potential before you risk real money in the markets.
You've given us so much to think about, I'm curious. For someone just starting out with WFA, what would you say is the most important thing to keep in mind? What's the one piece of advice you wish you'd had when you first started exploring this technique?
That's a great question. If I could go back and give my younger self one piece of advice about WFA, it would be this. Don't get lost in the technical details. Remember, WFA is a tool, not a magic bullet. It's not about finding the holy grail strategy that's guaranteed to make you rich.
So it's not about chasing those elusive get-rich-quick schemes.
Not at all. It's about understanding that trading is inherently risky. The markets are complex and unpredictable. And no strategy, no matter how well tested, can eliminate risk entirely.
That's a good reality check. It's easy to get caught up in the excitement of testing and optimizing and forget that there's always an element of uncertainty.
Exactly. WFA helps us manage that uncertainty, not eliminate it. It's about making more informed decisions, understanding the potential downsides, and having a plan for how to handle those unexpected market swings we talked about earlier.
So WFA is as much about risk management as it is about finding winning strategies. It's about knowing what you're getting into and being prepared for the unexpected.
Precisely. And that brings us to another crucial point, the importance of ongoing learning and adaptation. The markets are constantly evolving, so the strategies that worked yesterday might not work tomorrow. WFA is not a one-time exercise. It's a process of continuous improvement.
That resonates with me. It's like that saying, the only constant is change. We have to be willing to adapt and evolve our strategies
as the market landscape shifts.
Exactly. Always be questioning your assumptions, testing new ideas, and refining your approach. WFA is a fantastic tool for supporting that process of ongoing learning and development.
Well said. You've given us so much valuable information and insights today. It's clear that WFA is a powerful tool for any serious trader who wants to take their analysis to the next level. But as you've emphasized, it's not just about the technical aspects. It's about understanding the limitations, managing risk, and being prepared for the ever-changing nature of the markets.
You've captured it perfectly. I encourage everyone listening to explore WFA further, whether you're just starting out or you're a seasoned trader. There's always something new to learn and discover. Dive into those transcripts, experiment with different approaches, and see how WFA can enhance your trading journey.
Great advice. This deep dive has definitely given me a lot to think about and explore. And for those of you listening, I'm curious, what will you explore further? Based on what we've discussed today, perhaps you'll delve into the world of Monte Carlo WFA and try your hand at coding your own simulations. Or maybe you'll apply WFA to a strategy you're currently working on and see how it holds up under more rigorous testing. Whatever path you choose, remember to keep learning, stay curious, and never stop exploring the fascinating world of trading.
Gonna say it better myself. Happy exploring, everyone, from my